Ryan Detrick, the S&P is flat year to date after being up 30% last year. Why don't you comment on where you see the charts right now, where they're headed, and also maybe touch on the chart that's going around saying we're headed for a crash.
That's right. Right here, Greg, we're bullish. We continue to like the action. You look at the S&P, back above the 50-day moving average. The NASDAQ is making almost 14-year highs. Good leadership there. Housing starting to lead. So to us, we had that 6% correction. We call it a refreshing of the fear. People got a little too excited, and that's a good thing to refresh the fear. The market climbs a wall of worry. We still like that. Also, real quickly, March and April are the top 2 months going back the past 20 years. So seasonality-wise, things are still good. Now, real quickly on that 29 chart that's circling, that's scaring everyone. If you look at it based on percentages, yes, the charts look very similar, but based on percentages, 29, we were up so much more. The market was so much more extended. To us, it's just fear-mongering, and probably you should avoid it.
All right. A nice looking chart this year so far has been gold. Gold's up 9% if you look at the GLD chart compared to a flat S&P. Do you stick with gold?
We do think so. Last year we didn't like gold, but all of a sudden this year the expectations were so low. People were mocking people for being gold, just a couple months ago. Now, like you said, GLD's up about 9%, and most of the gold stocks are up anywhere from 20 to 30%. Last year, from the 2011 peak to the recent bottom, gold is down about 30%. A lot of those gold stocks are down anywhere from 60 to 80%. So now you got all that negativity with the improving price action. We think gold and gold stocks would be a nice contrarian play this year.
Looking at the so-called fear index, the VIX, it's at 14, but it was at 20 back in the fall. So that one's been pretty volatile. I guess that makes sense. The VIX has been volatile. Where do you see that headed?
That's right. When you look at the VIX, what we've seen historically, we think it's going to be muted. Now, by I say muted, I mean below 20. Back in the 90s, for 6 years, it was beneath that 20 level. Then again in the 2000s, about 4 years beneath the 20 level. So far, just since the beginning of 2012, we've been beneath 20. So to us, there's a lot of people that keep saying we're going to have this VIX spike up to 30, VIX spike up to 40. But history says the VIX can stay low, potentially for years, with so many people betting on a higher volatility or a higher VIX. That contrarian point of view makes us think, hey, we can have low volatility for another couple years, which should be a positive for the stock market.
Well, I like it. Thanks a lot, Ryan.
All right, thank you.
Thank you for watching The Street.